Calculating risk for a security. Some ways to calculate risk based on discrete statistics are risk value, where you multiply the probability of a risk by its impact to get a risk value. Risk reward, where you divide the net profit or reward by the price of the maximum risk. The value at risk, where you calculate the maximum loss that cannot be exceeded at a given confidence level. A value at risk is a popular measure of risk or in portfolio management. Conditional value at risk, where you calculate the average of the values that fall beyond the value at risk. Loss given default, a factor in quantifying risk that considers how much a lender stands to lose if the borrower defaults on a loan. Beta, which we will get to in depth in subsequent chapters, is a measure of an investment's systematic risk to the overall market. Beta is calculated by dividing the covariance of the excess returns of an investment and the market by the variance of the excess market returns over the risk-free rate. And lastly, standard deviation, which measures the dispersion of results from the expected value. Standard deviation, or SD, is a statistical measurement that measures the dispersion of a set of data points relative to their mean. Standard deviation is a measure of how far apart numbers are in a data set. It's the most common way to measure variability. Standard deviation is calculated as the square root of the variance. The variance is the average distance from the mean, and the calculation of variance weighs outliers more heavily than data closer to the mean. A higher standard deviation means the data is more spread out, while a lower standard deviation means the data is closer to the mean, i.e., it's a little safer. Standard deviation is used in many fields, including finance, obviously, and investing, to measure risk and volatility. Standard deviation is used to measure the riskiness of an asset. For example, a volatile stock has a high standard deviation, while a stable blue chip stock has a much lower standard deviation. Standard deviation is used to assess risk, manage business operations, and plan cash flows.